All right, welcome to the Explainer. Let's just jump right in, because today we're doing a deep dive into a true financial behemoth. I'm talking about a company that quite literally touches every single corner of the global markets, S&P Global. We're going to look under the hood to really understand their recent strategic restructuring, how they're positioning themselves in the market, and what the latest data actually tells us about their future. If you want to understand how a massive data and analytics firm recalibrates itself for growth, well, you're definitely in the right place. Here is our roadmap for today. We're going to hit the Q1 2026 earnings snapshot, look at workforce and operational shifts, cover recasting segment performance, benchmarking against competitors, talk about the dividend aristocrat, and then finally, wrap up with their strategic outlook in AI.
Okay, starting right off with Section 1, Q1 2026 earnings snapshot.
$4.171 billion. That is with a B, folks. S&P Global brought in a massive $4.171 billion in net revenue just for the first quarter of 2026. To put that into perspective, it represents a rock-solid 10% increase compared to the exact same period last year. And look, this growth wasn't just some happy accident. It was heavily driven by incredibly strong demand in their core high-margin segments, specifically ratings, indices, and market intelligence. Their strategic bet on expanding their market intelligence capabilities, it is absolutely paying off and directly feeding into this multi-billion-dollar top line. But hey, revenue is really only half the story, right? While top-line revenue grew by 10%, their adjusted earnings per share actually surged by 14%, landing at $4.97. That comfortably beat analyst forecasts, which were sitting around $4.82. So you might be wondering, how exactly did they outpace their own revenue growth on the bottom line? Well, it comes down to a really potent combination of strict cost management and overall operational efficiency. They managed a 10% rise in adjusted net income and strategically bought back shares to reduce their diluted shares outstanding. In fact, their adjusted operating margin bumped up by 100 basis points. Simply put, they are doing more and earning more with a much leaner operational footprint.
Moving right along to Section 2, workforce and operational shifts.
You know, to really understand where a company is heading, you've got to look at who they're hiring. Based on Revelio Labs workforce data, S&P Global is operating on a massive scale. We're talking 42,152 employees worldwide. That's the size of a small city. But they definitely aren't resting on their laurels. They had nearly 3,500 active job postings in 2025 alone. That's a 9.9% year-over-year increase in hiring. And this active hiring trend perfectly aligns with their aggressive push into new tech capabilities, especially AI and enhanced data analytics, which we're going to touch on a bit later. They are actively staffing up to build the future. Now, this is where it gets kind of interesting, because corporate growth is rarely perfectly smooth. On one hand, we've got a really robust 10.6% headcount growth from 2023 to 2025. But Revelio Labs' data also reveals a bit of a disconnect. Internal employee sentiment is currently neutral, and actually it's trending downward. Their average employee tenure is sitting right at about 4.1 years. So why does this matter to us? Well, as a company restructures, sheds whole divisions, and aggressively hires for totally new tech-focused roles, growing pains are just inevitable. It's a critical metric to keep an eye on, because maintaining a strong corporate culture is absolutely vital when you're going through massive transitional phases like this. All right, Section 3, recasting segment performance. Let's walk through this timeline, because it's a big deal. On July 1st, 2026, S&P Global successfully spun off its mobility division into its own independent public company called Mobility Global. Then, literally days later, on July 6th, they provided a pro forma recast of their financials to show what the business looks like without that mobility division weighing things down. Actually, it's more like showing off their new streamlined physique. This totally sets the stage for their upcoming Q2 earnings on July 28th, where they'll roll out updated 2026 guidance reflecting this new reality. They're actively shedding non-core assets so they can hyper-focus on their highest growth, most profitable areas. And when you isolate those 4 remaining core segments based on the recast data, the profitability is literally staggering. Following the restructure, their ratings division is boasting a 65% adjusted operating profit margin. In the indices division, no way, an unbelievable 70% margin. Energy is sitting pretty at 46% and market intelligence at 33%. By spinning off mobility, S&P Global has basically laid bare the incredible cash-generating engines that sit right at the heart of its business. It's wildly impressive. Which brings us to Section 4, benchmarking against competitors. So, how does S&P Global stack up against the other heavyweights? Using data from Trefis, let's look at the last 12 months, or LTM. S&P Global is showing a really strong operating margin of 40.3%. But take a look at Moody's at 44.9%, and MSCI just leading the entire pack at 54.7%. While hitting a 40% margin is objectively fantastic in almost any industry, MSCI commands that massive lead mostly because of their super lucrative asset-based index fees and just incredibly high subscription retention rates. S&P is an absolute powerhouse for sure, but in this specific neighborhood, they're facing fierce, highly efficient competition. So what does this all mean for their valuation? S&P Global is currently trading at a price-to-earnings, or PE ratio, of 30.1, with LTM revenue growth of 7.9%. Now, compare that to Moody's, sitting at a 34.1 PE and 8.9% growth, or MSCI up at a 35.5 PE and 9.7% growth. The big takeaway here is that S&P Global is currently trading at a more moderate and, honestly, perhaps more attractive valuation than its peers. But the upside could be a bit constrained if investors just keep paying a premium for that slightly faster growth and those superior margins over at Moody's and MSCI. Basically, S&P is kind of the value play in a high-growth sector right now.
Let's pivot to Section 5, the Dividend Aristocrat.
Talk about a track record. Since 1937, just pause and think about that for a second. Think about all the crazy economic cycles, the recessions, the global events that have happened since 1937. And yet, S&P Global has paid a dividend every single year. Plus, they are one of fewer than 30 companies in the entire S&P 500 that has increased its dividend annually for more than 50 consecutive years. This historical weight is just a massive part of their investment thesis. They are promising to return 100% or even more of their adjusted free cash flow straight back to shareholders through dividends and share repurchases. It's the definition of reliability.
Now, to fully appreciate that, we need to zoom out and look at the broader macroeconomic picture. According to an S&P Global Market Intelligence report, global aggregate dividends are projected to grow by just 2.9% in 2026. That's a pretty significant slowdown from previous years, mostly thanks to macroeconomic uncertainties and volatile interest rates. But there is a super fascinating split happening here. While global growth is tapping the brakes, dividends from U.S. S&P 500 companies are expected to surge by 6.4%. That signals incredible strength in the U.S. market, and with S&P Global's annualized dividend rate of $3.88 per share, they are absolutely positioned as a pillar of strength within that surging U.S. landscape.
And finally, Section 6, Strategic Outlook and AI.
So what's driving the ship for the rest of 2026? Here are their primary catalysts. They're projecting really confident revenue growth, somewhere between 6.3 and 8.3%. And a massive chunk of this growth relies on one big thing: the rapid adoption of AI functionality. AI is becoming absolutely crucial in leveling up their data analytics capabilities, letting them give clients much more sophisticated, predictive insights. And to fund all this, to really focus on this AI-driven future, they're continuing to shed non-core assets, like the planned divestiture of their geoscience and petroleum engineering software portfolio. They are getting leaner, they're getting smarter, and they are laser-focused on cutting-edge data tech.
Which leaves us with this final million-dollar question. We've looked at those insane 70% margins in their indices business, we've marveled at their 50-plus-year dividend track record, and we've seen them actively shed divisions to focus purely on high-growth data. But as they streamline their operations and aggressively embrace AI, can they actually close that growth gap? Can they truly outpace those ultra-high-margin peers like MSCI and Moody's in the years to come? It's definitely something to watch. Thanks for joining me on this explainer, and I'll see you next time.